Hi everyone, it's Jack about another video. Today I'm going to be talking about Intel, which just about an hour and a half ago released its Q4 earnings, and the results weren't so bad. Pretty much everything across the board was beating expectations. They had $3 billion in cost savings across 2023. Of course, there's a ton of spending coming on fabs, negative earnings for the year, negative free cash flow, and of course there's tough competition. The stock is getting absolutely walloped at the minute. It's down 8%, probably going to get worse as time goes on. This is a stock that has had a huge run this last year, so maybe it's a bit justified, a bit of a pullback. Up 65% in the past year, still not near its 2020 highs of in the $60 range. First, I want to talk about its valuation, how stretched it is right now, in my opinion. Then look at how it did in its results, where it struggled, where it did well. Look at the outlook, which is probably why it's getting hit so badly. And then whether I think it's a buy, sell or a hold going forward. So before I even get into the earnings, the stock valuation wise is looking a little stretched in my opinion. It's got negative free cash flow. It's trading for around 14 times operating cash flow versus a 5-year average of around 8, which is particularly expensive. None of these years has Intel been particularly impressive from an operating point of view, but in 2018, 19, 2020, they were looking a lot better than they are now, and it's trading at 100% premium to those values. Versus the index is probably about in line with it, but I don't think Intel is an above average stock right now. In terms of price of forward earnings, because price of trailing earnings is not had consistent earnings this year, price of forward earnings we're looking in the 20s. It's going to change a little bit with the most recent results, but we're still looking in the 20s. That is not really good enough for this business in my opinion. I would be looking at maximum probably price of earnings around 15 for this business in its current state. That is way too high. Negative earnings yield. There's just a lot of uncertainty around this business, as is to be expected. I don't really like buying businesses, or particularly these sort of legacy businesses, or not legacy, but mature, that have negative free cash flow, and I have had consistently. I think it's disappointing, and I think the valuation is certainly stretched, so it's completely reasonable that when outlook disappoints, that the stock is going to pull back some, so I don't even think 8% will be the last of it. I think there's going to be some continued pullback. Intel has kind of just rode the wave of other semiconductor stocks that have done really well. I mean, ASML's up 30% in a month. Many others are up even better. So I think they've kind of just rode the wave that's happened in the January rise for these semiconductor stocks. Of course, the stock price increase has not all just been wave riding. They've actually had a pretty decent year overall compared to where they were a year ago. And that is really the caveat here. A lot of these year-over-year numbers look decent. However, that's because a year ago they were absolutely putrid. So the big success is the client computing group is back with a vengeance. This is the biggest revenue segment for this business. That was up 33% year over year. The total revenue for Q4 was up to $15.4 billion. That was up 10% year over year. Although full year revenue was $54.2 billion. That's down 14%. Intel Foundry Services and Mobile recorded record revenues. However, these are large business segments, but relatively insignificant compared to the other ones. $11.9 billion negative free cash flow on an adjusted basis. Absolutely putrid. They're still paying out dividends, $3.1 billion. Even though they cut it, this should be absolutely eradicated in my opinion. They have no business paying out dividends or buying back shares at these prices. Current EPS that they recorded in the most recent quarter, non-GAAP of course, 54 cents. That's 260% up year over year. Above the October outlook, which they've been very keen on pushing. I'm not that impressed by this number because it's extremely low and the next ones aren't great, and it's a non-GAAP measure. Also looking on the quarter, network and edge down 24%. That's really not that great. Data center and AI down 10% year over year. And unlike network and edge, which they're sort of blaming on inventory and things like that, and just general market weakness, data center and AI is TAM reduction and also competition. Do you really see yourself betting on Intel to be beating AMD and Nvidia in this space? I don't. So a bit more of a summary in their own words in the recent quarter. 54 cents in earnings per share on a non-GAAP basis. That's up 260% year over year. 48.8% gross margin. That's up 5 percentage points year over year. 2.3 percentage points above the October outlook, which is decent in my opinion. And $15.4 billion of revenue, up 10% year over year. So if you're just looking at this on the face of it, you'd be expecting a decent bounce in the stock price. So obviously something deeper is it, and I'll give you a clue, it's the outlook, which we'll get to in a minute. As I mentioned, client computing grew the biggest revenue source by far. Over 50% of the revenue was up 33%. Operating income up a whopping 451%, mostly due to the massively increase in their operating margin from just 8% a year ago to 33% in this quarter. The reason for this is basically increasing revenue and increased sell-through of reserved inventory, so actually able to get rid of some inventory, not completely reduce prices, and they see a healthier alignment of sell-in and sell-through. In my opinion, the client computing group is really the only positive that can be drew from this report. Decent results there and decent results overall, but when you look at the network and edge, which I'm not going to go into because it's boring, and the IFS and Mobileye, which is so small that it's insignificant, looking at data center and AI group, this is really the meat and potatoes where you'll be expecting, judging by what other companies are doing, significant revenue growth, and they're blaming CPU TAM contraction, ongoing competitive pressure, and PSG inventory correction, and that has reduced revenue by 10% to $4 billion for the quarter. They've also, on a putrid operating margin of 3%, which is down significantly from where it was in 2021. It's gone down even further. They're making just $100 million in profit on $4 billion in revenue here. They're blaming ramp of higher cost next-gen products, lower revenue offset, getting rid of some inventory, which is the opposite problem to in the CCG group. But really, do we think Intel are ever going to be able to claw back the lead on AMD? Because really this should be a massive growth engine. You've heard constantly talk about data centers and AI being massive growth engines for basically every company that ever mentions them, and you see the numbers AMD are doing, and this is just absolutely poor performance from Intel in my opinion. So while there's pros and cons with this report, overall the business is seeing some sort of recovery, or has in the last quarter, so I don't think that is the reason for the stock price decline or the 8% decline we're seeing in the aftermarket. I think it is clearly the Q1 2024 outlook. $12.2 to $13.2 billion in revenue, so a fairly wide range. They're predicting it to be up 8% with a 44.5% gross margin, looking at around 13 cents in earnings per share. That's their expectations. The expectations of the market, or some analysts, the Outside Group, was looking at 14.5 billion in revenue, so that's a massive miss versus expectations. I mean, maybe they exceed, even if they come in at the top end, they're still over $1 billion away, and 33 cents in earnings per share. So again, over half of the earnings per share just wiped away versus expectations. This is not good enough in my opinion. The market clearly doesn't think it's good enough, and the stock price is getting hit because of it. This is a chart from ASML's earnings slides, and it's just how they expect total semiconductor revenue to go by 2030. They're expecting this to top $1 trillion. That's almost doubling from where it is today, around 600 million, depending on which source you look at. And this is why I'm not really willing to give Intel much leeway. Yes, in 26, 27, 28, 29, Intel may very well be able to capture some market share, but they are so behind the competitors. They've got a ton of capex coming forward. They're negative free cash flows. I think this is a very, very tough road, even with a lot of money from the CHIPS Act and things like that. I just think this is a business to go in the too hard pile. I don't think they're well capitalized to deal with this. They have around $25 billion in cash on the balance sheet. A lot of that's going to be after spent on all these mega projects, and around $40 billion in debt. Negative free cash flow, it just looks ugly for me, and I'd much rather invest, even at the price they are now, in the likes of AMD, Nvidia, or even the sort of picks and shovels plays, KLA, ASML, Applied Materials, Lam Research. They just seem like better ways to play the semiconductor industry for me. I'm an ASML investor, and that rewarded me greatly more than investing in Intel, despite the valuation difference. The summary for me is it's a decent quarter, very good compared to the recent performance, but let's not discount that. The recent performance was terrible, so this is a decent quarter. They had a decent beat, however the outlook looks absolutely terrible again. I'm just not really willing to give this company much lease, and for me, I don't think it can be a buy right now. Don't think this quarter is good enough, and I think how much is ran up, the valuation is so murky because there's not really consistent profits. I definitely think this stock is going to take more of a haircut than it has already. It's run up a decent amount right off its 52-week highs. I can see it going down 10% or more tomorrow, and I can see it only getting worse in times to come. I don't think it's a particularly easy to come up with a strong investment case for Intel right now, other than in 5 years it may be in a better position. I definitely think there's better opportunities right now. Of course, that's just my opinion. You let me know your opinion down in the comments below. I'm of course not a financial advisor, so you should do your own research and due diligence. Take none of this as direct financial advice. Do your own research and due diligence, come up with your own stock ideas, and let me know some in the comments down below. Like and subscribe and enjoy the video. I'll see you again next time.